Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, and it's generally related to three different topics: wealth building, financial topics, and or commodity related topics. So let's dive in. Let's see what people are talking about on Twitter. If you want to follow me at finding_finance, and if you want to follow or join our community at the website, finding-value.com, you can use a discount coupon code called LEAP, LEAP. And that's where we go into individual companies, individual sectors, and where I openly share my opinions about companies. So Warren says a market transition is taking place from second half of 2023. Rates drove the stock market lower in quarter three, then higher in quarter four. In 2024, though, stocks have broken away from the pull of interest rates. A few charts from last week's report. And I talk a lot about lowering of interest rates. It's a tailwind behind the stock market. Increasing interest rates is a headwind for the stock market. This is the data to provide that viewpoint. I've seen a lot of similar charts in history. This is just a recent chart that he's got updated. So this is the 10-year Treasury yield on the x-axis, and this is the S&P 500 value, the price of what the S&P 500 is valued at. And you can see as interest rates go up, generally speaking, the stock market goes down. And as you can see, a bunch of outliers occur in the dark blue dots. This is the relationship since 12/31/2023 as of 2/5/2024. So we've got a lot of data points since the beginning of this year, basically falling outside of the normal dot plot and that correlation of interest rates and the pricing of where the S&P 500 is. One could say that it's breaking this relationship, maybe, or another person could say this is a blow off top and that the S&P 500 and NASDAQ are basically forming a top. And eventually the value will come back to this area in here. The bigger question that a lot of people should be asking is, okay, this is weird, number one, but number two, where do we think interest rates are actually going to go in the future? If they actually start to move up in the 10-year, what do you think is going to happen to the S&P 500 that's priced where it is if this is going to move to the right? I think we're going to see a big pullback in the S&P 500 if rates either continue to be where they're at or they move higher. And that's the risk. Buying things when they're up here is risky. Buying them when they're down here is not risky if you think that interest rates are going to eventually turn around. So a lot of it is speculating on where interest rates are going to go in the future for the pricing of a lot of these assets. And a big part of the market conditions is rooted in interest rates. So keep that in mind. And right now we are, I would say, overvalued in relationship historically to where the interest rates are at today. I'll read this one later about Gary. We'll go over that one at the end. It's a little bit long. Nat Gas looking for patterns in the clouds, the 4-year cycle highs and lows. And what he took is this. He basically put the red dots of where the lows are. Low, 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 and then another potential low of right where we're at today, where we could be getting a very good buying opportunity where this is going to basically bottom out and start to turn for natural gas. I think this is a huge opportunity in natural gas to be looking at potential entry points over the next month or two. I do think that we are very close to a bottom, but it may take a little bit of time. Maybe it sits down there for 2-3 months, but potentially. I'm afraid for my dad's retirement. He can't wait to retire from his job, but he doesn't have much to retire to. When I ask, he says he'll do more work around the yard, see family more, and watch more sports. What do you think? Is that enough for a satisfying retirement? Well, I I work from home. I do these YouTube clips. I do the website, and I don't do my normal 9 to 5 job anymore. So I do have spare time, depending on how you look at it. I like looking at stocks. I like doing all that stuff. So that doesn't really feel like work. Now, to be in like full retirement, that means you're not working at all. And you know, my parents, they don't. I mean, they basically just stay at home, and then do things around that city. They don't really travel all that much, and I could understand why. I'm not a huge traveler either. I don't like flying on airplane rides for very long periods of time. I just don't like it. A couple hours, 2 hours, 3 hours, not a big deal. But if I'm on there for 10 plus hours, I really don't like airplane rides that long. So I'm not a huge traveler. Getting out every once in a while, whatever. But I don't want to be traveling every other week or anything like that. So yeah, I think that is enough. If it, when you get money, this is what I'll say: the more money you get, you just want to get crap out of your life that you don't like doing. The inconveniences, the annoyances, the things that you just don't want to deal with. Like money is more about the convenience than it is about messing around with a 9 to 5 job that you have to attend. As you build wealth, as you get more dividend income, as things start to move in your direction, you're trying to avoid the things that you don't like in life, like basically price that crap out of your life. And if you don't, I mean, you don't have to travel, you don't have to have certain things that people say, well, what are you going to do? If you have to go to a 9 to 5 job to do something that you don't like doing, that's pretty rough. Like basically, your life is pretty much screwed. So, what I do is I work out. I work out a lot. I go on long walks in the sun. I try to get as much sun as I can, even in the winter. Um, I try to clear my thoughts. I think more about the things that I want to think about, and I think less about the things that I don't want to think about. A 9 to 5 job consumes your brain, and it consumes it with stuff that may not allow you to make positive strides in what you want to do. Now that I'm thinking more about stocks, more about whatever, it's far more, one, I'm better at it, and two, it's far more satisfying. What's more important, cutting expenses or earning more money? I think it's a combination of both things. It's maximizing your investable income if that is what your goal is. If you want to invest more money, because I mean, earning more money and cutting expenses is generally for a reason, and it's generally for investing more money. So I think they're equally as important. Earning more money, I think, is harder for the majority of people, and I think cutting expenses has an immediate impact, and it's very easy to do. You have a lot more control on cutting expenses quickly than you would on doubling your earnings in a single year. But focusing on both and maximizing the difference is really where building wealth is maximized. Everyone wants financial freedom until they have to pay for their own health insurance. You got that right. Guys, health insurance is ridiculous. What the heck happened? Obama just destroyed the health insurance. Jesus. Um, when I look at health insurance, it's ridiculous for a family and doing it by yourself. So my wife works. She likes, she wants to do a career. I'm like, all right, you go do that. Just make sure you get health insurance. So that's why I'm sharing this one. Both completed wells and DUCS continue to fall in January. So here's completed wells in the green. You can see crude oil production is going up and completed wells is starting to go down. It's probably going to have an impact eventually on crude oil production eventually. And then on the right-hand side, we've got U.S. Duke wells versus crude oil production, and we're basically depleting the inventory of drilled and completed wells. And at some point, we're going to have to drill more wells. So when we drill more wells, what occurs? Energy service companies are going to be their drilling rigs and stuff will be in more demand. Global oil demand would have been 6 million barrels per day higher in 2023, 107 versus 101, if COVID never happened and oil consumption continued growing at its pre pandemic pace of 1.5%. Would have been quite the market to see. And I agree with that. I don't even know if we can produce 107 million barrels per day. And maybe that's one of the reasons why they did the pandemic. Maybe that's one of the reasons to slow down this growth. Maybe. I don't know. When price is the only balancing mechanism, it can always get crazier than people understand is possible. That's both to the high side and the low side. This has to happen and is so much better than plodding along at $2.50 like last February, March, especially with E&P more exposed. So there's a very important thing I want to share here on this chart that a lot of people do not understand. So it says inadequate natural gas storage will amplify price volatility. Let me say that again. Inadequate natural gas storage will amplify price volatility. It says the lack of storage capacity relative to demand, limiting coal switching ability and renewable intermittency will amplify price volatility. So US gas storage days of LTM demand cover. So when we were back in '08, we had 45 days of coverage when you had your inventory kind of going up. But since we've adopted so much in terms of power burn into the system, and on top of it, the intermittency from a lot of these renewables is relying on natural gas to cover the difference, we haven't really expanded our inventory levels to cover all of the demand that's been added to the system. It says gas storage capacity relative to demand is near all-time lows. And I've tried to explain this um, to a lot of the people on the website that are members. It's like, guys, we are getting really low. This is what it looks like if you were to basically adjust it for the days of demand cover. And this is how low we would be. We're basically almost off the chart for how low inventory level is given the demand that is out there. Now, we've stayed on the right side of things with how warm the weather's been. Now, if the weather gets cold and we don't have these renewable energy power sources basically working, and remember that this is all weather related. Warm or cold weather is weather related, and you've got renewables that are also weather related. The swing producer is coming from natural gas. This is the swing producer. Now, what if you don't have renewables working and you get cold weather at the same time? We're going to blow through this inventory and it's going to look absolutely ridiculous on how high the price of natural gas will go to kill demand. Because, I mean, how are you going to kill it through electricity generation? You're going to tell people to shut off their lights and shut down, turn down their thermostats? Maybe. But I mean, this is going to get very volatile in terms of natural gas. And with the price where it's at today, it's a heck of an entry point. It says under this dynamic, price is increasingly becoming the only mechanism to balance inventories, creating a more volatile gas pricing market. God, this is an investor's dream, guys. It's an investor's dream to have this type of volatility potential if something goes wrong on the supply side. Oh my goodness. And on the demand side too, if it's cold weather. I mean, this is all, a lot of it's going to be weather related and renewable related. Remember, weather being two components. One of the components is the temperature on the hot side and the cold side. And the second one is how the utilization of renewables, the uptime utilization. So U.S. oil supply can grow, but the treadmill is not slowing down. Fang is now, which is Diamondback, the third largest Permian player at 816,000 barrels of oil equivalent a day. They say that the base total decline is 31% in the Permian lands. Need to add 250,000 barrels per day to keep the Permian flat. We are getting close potentially to um, maybe potentially to peak production from the Permian, maybe. And I think that's what a lot of people are looking at, peak production from the Permian over the next year or two. While Baker Hughes' rig count has held stubbornly steady, completed nat gas wells in the key Haynesville formation fell to just 39 wells in January, down 14 wells or minus 26% from 2023, and the lowest since April of 2022. With gas prices down minus 17% so far in February, expect this trend to continue. So we are seeing evidence of wells and completed wells and DUCS and all that stuff depleting and being pulled back due to the pricing of natural gas. So that's a good thing. And eventually we will bottom at some point, probably over the next few months, and we're going to have an entry point of a lifetime. There's no art. It says there really is no argument. College degrees make millionaires. Yeah, there is an argument. I'll give you an argument. And the reason he put there's no really argument, and this, I mean, that's the reason I've added it here because there's no argument. I will tell you what really is the driver. College degrees is not what makes millionaires. That is not the driver. The driver is smart people. So when you look at the acceptance, to these colleges, um, Harvard, MIT, Caltech, obviously they get really, really smart people. If they didn't go to MIT, Caltech, and Harvard, they would still be very smart people and they would still be successful if they didn't go to college. What makes everything here is how smart the people are. The college degree is meaningless. That's just programs being loaded on smart people. If you look at basically the way that everything is structured in our system, there's basically a tax on being really stupid, and it's rightfully so. Um, Smarter people live longer lives on average. Smarter people have higher FICO scores. Smarter people get in less accidents. All of it adds up and makes sense. Smarter people make more money. Smarter people hold probably more college degrees because smarter people make better decisions, and that compounds over the life of the person. Now, I'm not saying that all smart people will be rich. I'm not saying that all smart people are going to be better drivers. I'm not saying that. What I'm saying is, statistically speaking, smart people are healthier, they live longer, they make better decisions across the board, whether it be financially, health related, et cetera, et cetera, et cetera. And a large component of that is genetics based in terms of how smart a person will be. College is not going to make a dumb person smart. It just loads programs onto the person, and it maybe potentially gives them a certain viewpoint to look at the world, whether that's a good thing or a bad thing. Because I know a lot of college degrees now are probably loading some pretty crappy stuff into people, depending on what degree you're getting. This one says, what advice would you give to a first year engineering student? I would tell you this, and you're probably not going to like what I'm going to say. I'm going to say that engineering people are the smartest dumb people that I know. And what do I mean by that? They're very smart in terms of book, they're very smart in terms of figuring out problems, putting designs. But I'm going to tell you this, guys, the business guys and the other management and all that, they're going to take advantage of you. They're going to take advantage of you. They're going to work you really hard and you're going to earn your money. You're going to look around. If you're real smart, you look around, there's a lot of people in a lot of these big corporations that don't do crap. All of the value in the company is really created by engineers, and it is put together by people who either build the product or build the lines that create that value for the company. A lot of the other people in that company are adding very little value. It's very easy to order something. It's very hard to construct a very good design from nothing. So engineers, in my opinion, are the most underpaid smart people out there. You've got an IQ or a background in something that you can run with surgeons if you like. You're just as smart as them. You're smarter than the majority of high paid lawyers and stuff like that. You're just choosing the wrong area to make money in. That's what I would say. My brother and I, we have engineering degrees, And we both were engineers, and we look back and we say we worked so hard for so little money. It was unbelievable in the beginning of our careers. And now we look back, and I don't know. I don't know exactly what he makes. Maybe he makes five or $600,000 a year or something like that. And he looks at that and he goes, "What was I doing?" He's in sales right now. He sells stuff to big corporations, and he earns a percentage of the sales. Engineering students and engineers, they don't earn crap unless you open up your own company or you work for a company that shares its profits with you. But an engineering degree is great. It makes you, I think, a very good problem solver and a very good thinker. But really don't get paid very well for, I would say, the knowledge that you gained going through school. Because when you look around, I mean, a lot of these people, they are not very smart people. I mean, go look at supply chain. And here's another thing: if you want to dominate, don't try to dominate in the engineering game. Go dominate in like supply chain or materials or something in some other area. Planning, because I mean, you're like a shark swimming with guppies that don't know where to go. It is so easy when you go outside of the engineering stent. But that's my opinion. This is Buren, I think that's how you pronounce his name. It says if earnings have inflected in quarter three, the investment clock below should follow the typical pattern of moving clockwise from lower left to upper right. The combination of easier financial conditions from a looser Fed and accelerating earnings growth should bode well for equities. So basically, this is a slowdown. When you look at generally the clock here, a slowdown comes, it generally goes this way, wraps around, and then comes back up. But notice something here. This is where financial conditions loosen and earnings are down. Financial conditions. So this is financial conditions loose and earnings are up. I think we were going to come back up in this direction here. October of 2020 was the low, and I think that's probably where we're at right now. October of 2020 is where I purchased all of my oil and gas stocks. And right now we're in that similar region. It didn't go down as much, but we're in the very similar region where this could come back up around. And that's where oil takes off and natural gas take off. And a lot of these different commodities really start to take off. And we see all of the technical chart patterns basically aligning with that, with this clock coming back up. So I completely agree with his opinion. I think that's exactly where we're located. And it feels very much like October, September of 2020, or even a little bit before that. It's getting there. Listen to Einhorn's interview, and he basically said that companies cash flowing 15 to 20% and buying back their own stock because no one else wants it are prime investments. It says, where could we find these type of companies? I know exactly where. We're buying them on the website. We're buying exactly what he just said. We have free, so cash flowing companies are greater than this, or the potential is greater in the next year or two, and they're buying back their own stock. We are buying these exact investments and loading our portfolios up right now in just absolutely ridiculous prices in terms of enterprise value to cash flow valuations. They still boggle my mind. And here's the thing, guys. The upside potential of these companies that I'm looking at, some of them last bull market. Now, we're not at the bottom of the bull market, but some of them went up 100x from bottom to top. And I think we could still get 20 or 30x out of them. Striking words from Siemens Energy chairman and former CEO. If you want to have cheap energy, you need to be gas fired, natural gas fired. That's the cheapest way, the most secure way if you calculate the whole thing from the beginning to the end. One of the shortcomings of the wind industry in the last 5 years is that there were a lot of announcements, a lot of plans, he explained. But they took 4, 5, 6 years sometimes to go from order to execution. The matter of renewables being volatile, if there's a windless night, it could get complicated if you don't have storage. So need to think, what is my energy agenda? How much do I need to have of renewables? How do we deal with the fact that sometimes availability and demand don't match. The story of green hydrogen is another fairy tale. If you believe in the next 5 years in industry, it's a feasible option. It's not. I believe that for a while, customers need to accept higher pricing. The boss of Britain's biggest wind turbine statements go against the often heard narrative that wind is cheaper than gas. Wind is quick to deliver, and wind's intermittency isn't a big deal. I applaud Mr. Kaiser for his frank words. The wind industry, politicians, and environmentalists may be upset by the lack of optimism, but in my mind, the public will be reassured by the honest discussion of net zero challenges and trade offs. Without the public's confidence, there couldn't be a net zero transition. So again, I want to go back to one thing. What did he say? He said, if you want to have cheap energy, you need to be gas fired. Natural gas is what's growing the fastest. And if these renewables aren't coming on in time, and if they're not working with the utilization rates that we are hoping they work for, we're going to burn natural gas either way. Natural gas is going to be the thing that we're all going to rely on. And guess what? We don't have the inventory levels to really buffer against this intermittency from the renewables. And if we can't build nuclear fast enough, we're going to put natural gas plants everywhere, guys. Natural gas and the pricing of where it is today it's laughable. It's such a good opportunity. And I've got a bunch of picks that we can capitalize on this natural gas play. If you guys want to join the website, I'll just put my plug in there. Use LEAP as a LEAP as a discount. A stunning stock market valuation gap has opened between China and US. China's A shares are earning 10+% earnings yield is 8 percentage points more than the 2.4% available on government bonds. In contrast, the S&P 500's approximate 5% earnings yield is barely above bond yields. And you know what that is? It's because I think the S&P 500 is getting too expensive. And I think that the Chinese market is probably getting too cheap. They're in a bust and we're in a bubble. That's exactly what we're seeing. Here's the China bubble. You can see how low it got. This is the 2000 US bubble. When you're low on this chart, you're in bubble territory. Does it mean that it will crash immediately? I'm not saying it will crash immediately, but we're getting into bubble territory here. And up at the top is where it's real cheap. That's where you want to purchase. You buy here and here, and then you ride it down. You buy up here and here, and you ride it down. A majority of life's errors are caused by forgetting what one is really trying to do. I completely agree with that. I know a lot of people who don't have their life, like, they don't have any goals in their life. So they wander around, take these stupid jobs. They go into the job, and then they say, God, I really hate this. It's like, okay, is that job getting you to the direction and to the goal that you want for your life? And it's like, they're like, not really. I just wanted to make six figures. And it's like, oh my gosh. So, yes, the majority of life errors are caused by forgetting what one is really trying to do because they don't know what they're trying to do. They don't have a plan for their life. Um, I won't go over that one. So this is gold here, holding over the yearly MA, which may need another tap within the uptrend channel. Otherwise, we're gathering energy ready for the pulse towards the next target in gold. We have a nice cup and handle developing and inverted head and shoulders. Let's rip this thing, guys. Let's rip it. Here's Cuppy here. I like Cuppy. He says Bitcoin is telling you that the Fed needs to raise rates and accelerate QT to soak up all the RRP liquidity. Meanwhile, the street still thinks that the Fed will do 5 to 7 rate cuts this year. Either they raise rates rapidly to save the bond market, or they lose the whole banking system. This will become obvious and existential soon. There you go. It's from Cuppy himself. This is in the first 6 weeks of 2023, global oil inventories rose by 40 million barrels this year, question mark, question mark. They have fallen by 81 million barrels and now stand at their lowest levels since KLPR data began 2017, despite absorbing 268 million net barrels from the Strategic Petroleum Reserve. Stronger than consensus demand plus will and intent matter. And here we are pulling back in our global oil inventories onshore and offshore. guys, we're going to get to really low levels here. And last time we were at these levels, oil was not in the 70s. We were up in the hundreds. So this is such an underpriced area. Plus, I mean, we don't even look at the Strategic Petroleum Reserve. We consider that as new like supply, and that is really an inventory. So we're just draining inventories around the world, is what we're doing, onshore and offshore. And then when we hit critical levels, the price is going to rocket. It's going to rocket like a beast. And what's going to happen? Oil prices go up, interest rates go up. This whole thing gets real nasty. And then we're going to see the stock market crash because interest rates are going to go up at a fast enough pace. And we just looked at where the interest rates were and how overvalued the S&P 500 is to the current interest rate. Good luck. Okay, I already went over that. So that's what I've got for today, guys. We'll end it there. Give me a thumb up, subscribe to the channel, subscribe to the website if you'd like. And that's what I've got for today. So we'll catch you next time. This is Finding Value.